In this video, we're going to talk about capital structure. This is one of the more complicated, if you will, concepts in finance. There are certainly theories, research, there are some techniques that we can talk about, but in the end, the choice of borrowing money and how much money to borrow is a choice that is more of a personal choice. Certainly in the personal finance realm, but even at the corporate realm, some companies choose to be a little riskier, to borrow a little bit more than maybe the average company. The questions we have in the end then is, given whatever choice is made, how does the company handle that amount of financing? So let's go on with our discussion. The first thing we need to kind of understand is a little bit about what's referred to as business risk. Now, this is the risk that's chosen. Chosen is not quite the right word, but it's the kind of risk that you get when you decide what line of business to be in. It talks about the riskiness of the firm's operations. And in this case, business risk assumes that there's no debt. We're not looking at financing, we're just looking at business risk. Now, the most common measure is the standard deviation of return on invested capital. So what determines business risk? And what I wanted to kind of highlight here is that as you look at this list of things, right, of these characteristics of doing business, most of them, with the exception of really the last one, is given to you when you choose the business, right? How much competition there is, any kind of uncertainty with products or prices, obsolescence, right? Foreign risk, regulation, all of those things are kind of chosen when you choose the business. The one thing that is a choice of the business, though, is what we refer to as operating leverage. Operating leverage, in essence, is the use of fixed assets to perform the process of sales, right? So some industries are very intensive with capital assets. Some have almost no capital assets at all. But there is a mixture in there where some companies can choose the level of fixed costs that they have. So again, just to kind of review, right? Operating leverage is the use of fixed costs. Again, most cases, these costs, we refer to them as fixed, right? We've talked about this in many other classes, I'm sure, certainly in other videos. But these are assets that it doesn't really depend on the demand. Once you choose these assets, you have them, and the cost is fixed, it's maintained, it doesn't change. So let's think about business risk, and a way of referring to business risk is something called operating leverage. So operating leverage is the use of fixed assets, and essentially a definition is says for a small sales decline, there could be a big change in profits. So if sales drop a little, profits can drop much more, relatively speaking. So we have a couple of graphs here that represent two different kinds of businesses, right? The revenue, this upper line obviously is the revenue from the company. The total cost, we'll talk about this in more detail a little bit later, but this is essentially the cost of doing business. So it's the variable cost of the business and the fixed cost of the business. Now down below here, what you see is we also have the fixed cost line. If you look at the difference between the two graphs, although revenue looks fairly similar, right? It's not quite lined up, but pretty close. The difference in here is the fixed cost. So variable costs are the same, but fixed costs are much different. How do we understand, or what is the picture trying to tell us? Well, when we talk about operating leverage, you're talking about the chance that you won't be able to sell a certain amount of goods. The goods, the level we're looking at is break even. We'll talk about this again as videos go on. But one of the things you can see is that the break even point for this graph is farther to the left than here. So when we have lower fixed costs, we tend to have lower break even points, which means that you need to sell less units just to get to zero income. And of course, the more units you have to sell, the more risk there is. So if you have low operating leverage, again, we see the graphically here, you can see that relatively speaking, the dispersion, right, is rather narrow, right? There's less risk. When you look at the high operating leverage company, we also see that it's more spread out. If you remember our discussions of risk, we're referring to the variance or the standard deviation, and the greater that standard deviation, the greater the risk of the company. The higher operating leverage, higher risk. So let's start with talking about the variable return on invested capital. It's EBIT times 1 minus T. So this is the operating profit after taxes divided by the total invested capital. So we have $400,000 of EBIT, the tax rate's 25%, and our invested capital is $2 million. So for this particular company, the ROIC is 15%. Now, the return on invested capital doesn't vary, doesn't change with changes in capital structure, right? There's nothing here that refers to financing. Financial leverage is the use of debt and preferred stock in gathering funds. So these are essentially what we would refer to as fixed cost financing tools, right? You have to make interest payments if you borrow money. The dividends, although you're not obligated, they are of a fixed nature when you think about preferred stock. So financial risk is that additional risk that's concentrated on stockholders as a result of financial leverage. So how do we combine these two? What's the combination that we're talking about here? Business risk depends on business factors, right? Competition, etc. We talked about all of those. But one of the things that we do have some choice on is operating leverage, because we choose the kinds of assets that we buy. And financial risk depends on the types of securities we've issued, right? More debt means there's more financial risk. So let's take an example and see how financial leverage impacts the company. So you have two companies, they have the exact same operating leverage, right? Business risk, the probability of earnings before it, those are all the same. They only differ with respect to the use of debt. So firm U, right? Unlevered is what that means. Unlevered, no debt. They have no debt, 20,000 invested capital, and they have 25% tax rate. Firm L, company with leverage, 10,000 of 12% debt. There's their invested capital, again, the same tax rate. So let's see how this affects the balance sheets and the income statement. So let's think about a good, bad, and an average kind of economy. We have some probabilities. What's the EBIT based on these kinds of economies? Well, again, the EBIT changes, obviously. It's higher. There's no interest for company U. So the EBT is the same, but now we have taxes, and the net income for company U is either $1,500, $2,250, or $3,000. Now what we're going to do shortly is we will calculate the statistics on this particular net income stream. So now let's look at L. Again, EBIT is the same, but now don't forget we have 12% interest. So $1,200 is the interest payment. Gives us our EBT range, 25% is the tax, and now we see the net income has changed. We have $600 in a bad economy, $1,350 in average, and $2,100 in a good economy. So how do these two companies relate with respect to these income levels? So firm U, return on invested capital. What you see here, since they have no debt, there's really no difference between their return on invested capital and return on equity, because again, there is no financing to alter those numbers. They're the same. But what happens when we look at return on invested capital for the leverage company? As we mentioned earlier, the kind of capital structure does not affect the return on capital, right? The return on investment, return on assets, right? The return on capital. It doesn't affect those, but it does affect ROE. And what we find is in a bad economy, we're going to earn less as investors, 6.0. 13.5% is we get a higher return of equity in an average economy and a much higher level of profit when you think about a good economy. So what we can gather from this is really two things. Number one, that the financing doesn't affect what kind of assets you buy. It's just a method of buying those assets. Return on equity is impacted because there is an impact on profits. That implies that with the change in profits, there will be a change of return on equity since that is taken out after taxes at the very end. In addition, here we see that TIE, the times interest earned ratio, also increases as we borrow more. And of course, we would expect that since it is a measure of, given the profit that we have, what is our ability to handle that level of profit. So again, let's kind of think back about these two companies again, right? The expected return on invested capital, we know what those numbers are. We know what the expected return on equity is. Again, this is doing the calculation using the same kind of a spreadsheet that we used with standalone risk. And of course, the expected or the average TIE ratio, 2.5 for the levered firm. So what are the statistics of this? When you do the statistical analysis, we see that, again, the statistics are identical. It doesn't really change for the unlevered company. But what we do see is that the statistics, the risk to our return on equity, the risk to the profits to owners, increases as you increase the amount of financing. The return goes up and the risk obviously goes up. In addition, we also have statistics that measure the riskiness or the uncertainty of that TIE ratio. So what do we get from this? Right? What, in summary, what are our conclusions? Well, first, for leverage to raise ROE, you have to have a return on invested capital that's greater than its after-tax cost of debt. So in other words, right, if the cost of financing, right, if that is greater than the return on invested capital, you won't have an increase in ROE. Why is that? Well, obviously because the expense of doing the business is greater than the return of doing business. So leverage ultimately will depress or hold down income. As debt increases, in additional, TIE will decrease because EBIT is unaffected by debt, right? But interest expense increases. So again, if we're in this situation where the cost of financing is greater than the profits that we earn from doing the business, that has a negative influence on the income and the profitability of the company in general. So again, just to kind of finalize here, return on invested capital was unaffected, right? The firm L has higher expected ROE because, in this case, ROIC, the return on invested capital, is greater than the after-tax cost of debt. And again, L has much wider ROE and earnings per share swings because of the fixed interest charges, right? The higher the expected return is accompanied by higher risk. So higher risk, higher returns continue to be an influence in our decision making and performance in a company. I look forward to talking to you next time.